Hello, welcome to CDH's YouTube channel. My name is Ko Fujimoto. I'm going to talk about the second part of US exit tax. How you get taxed is today's topic. Let's get started. Give you a quick overview of US exit tax system. US citizen or green card holder who is a long-term resident may want to give up their status, renounce citizenship, or abandon green card status. There will be three tests that such a person must go through. Number one is net worth test, $2 million or more, at net asset size. Number two is federal income tax compliance testing for the 5 years. And number three is federal income tax liability testing. If you fail one of these three tests, you become a covered expatriate. And today's topic is this US exit tax. What's the system? How you get taxed, right? There are three taxations. One is mark-to-market. Number two is 30% withholding for deferred compensation items, which is eligible. Number three is immediate taxation in the tax returns. And then you file 1040 annual dual status return with Form 8854 and may have to come up with taxes. But today, I am going to focus on this US exit tax system, how you get taxed. So let's get started with number one, mark-to-market taxation. Mark-to-market taxation, the day before you give up your status, you are deemed to have sold any interest in property. In an easier way to say it is, let's assume you sell all of your property day before you give up your green card. And you get a proceed, you get money, which represents that it's a fair market value, FMV, right? Fair market value. Fair market values include, in this taxation, three items. One is a basis of the property. In an easier way to say it, it's a cost. For the resident, US resident, green card holders, there is a special rule called inbound step-up basis for non-resident aliens becoming resident aliens. And I'm not gonna explain this in this video because it gets too long. So just remember, there is a special rule. If you purchase a property before you became a US resident, okay? In 2023, the IRS will is giving you a break, exclusion amount of $821,000 per person, not per property, per person. This is indexed for inflation, so it may change next year. And anything above that is subject to mark-to-market taxation. Capital gain tax rates would apply. Oops, excuse me. So there are 3 or 4 additional points that I want to make. Number one, allocate the annual exclusion to each property, I think pro rata basis with a built-in gain items only. Meaning if you have mixed properties, I have items with a built-in loss and built-in gain, only pick the built-in gain property or stocks, and then pro rata basis allocate this exclusion and calculate the gain amount. And because you have not sold these properties in reality, you do not have a proceed, and that means you cannot pay taxes. IRS allows you to, elect and defer taxation or taxes. I think you need to post up security. Number three, cash generally has no built-in gain, so if you have a lot of cash, that's not subject to exit tax at all. And even if I become a covered expatriate, I can before I can give away, if I have a choice, I can give away the items with a high built-in gain item so that I can minimize this mark-to-market taxation. Okay? So let's get to the next point. Next one is called eligible deferred compensation items. 30% withholding taxation. Deferred compensation meaning you work and you get paid later. 401k, 403b, simple IRA, SEP IRA, restricted stock units, and company pensions, and so forth. And there are basically a deferred compensation items. Now, in this case, there is one more word, eligible. In order to become eligible deferred compensation items, there are two conditions. One is the payor is either a U.S. person or non-U.S. person who elects to be treated as a U.S. person. I don't think this would be happening to too many foreign persons. So pretty much eligible deferred compensation items are U.S. employer or U.S. custodian of the accounts. The covered expatriates now needs to do something. Notifies the payor or his or her status as a covered expatriate. I am a covered expatriate, Mr. Custodian, and irrevocably waives any right to claim any withholding reduction under any treaty with the United States. In a simple word, even if, let's say I live in Japan now, and because of the Japan-US tax treaty, US has no rights to withhold any money on my 401k distribution, but I need to waive that such a right. Okay, this only applies to withholding reduction. You get this point? It's important. So then you submit W8C form. Its name is Notice of Expatriation and Waiver of Treaty Benefits. Give an example. 401k, I became a covered expatriate and I want to start withdrawing, start receiving my distribution. This year I want to take $30,000, but because I was a covered expatriate, 30% of $30,000, $9,000 must go to IRS. I only received $21,000. Now, depending on the income tax treaty that I can use, I may be able to file 1040 NOR, non-resident return, to get $9,000 back, but it depends on the country where you live, only if the treaty allows. Now, so this exit tax limitation only applies to withholding reduction under any treaty. Please remember this. I think a lot of people, including myself, did not or do not notice this. Finally, immediate taxation items. There is one item which is ineligible deferred compensation items. So I talked about the eligible deferred compensation item before. If they did not, if the item does not meet one of these two criteria or both of the criteria, it becomes ineligible deferred compensation items. So if that happens, an amount equal to the present value of the covered expatriate's accrued benefit is treated as having been received by the covered expatriate on the day before the expatriation date. So in a simple word, well, IRS is saying that, well, please assume you received the entire amount the day before you expatriate. Number two is specified tax deferred accounts. One more time, specified tax deferred accounts. Examples are IRA, HSA, health saving account, and Section 529. Very similar way, a covered expatriate is treated as having received a distribution of his or her entire interest in such an account on the day before the expatriation date, right? It's pretty much the same ineligible deferred compensation items and specified tax deferred accounts. And next one is the obligation of the custodian. Within 60 days of receipt of a properly completed Form W8CE, the custodian must advise the covered expatriate of the amount of the covered expatriate's entire interest in his or her account on the day before his or her expatriation date. So this is the nutshell of immediate taxation. I should point out a few things here. WHC, timely filing is very important. If you miss the deadline, then your eligible deferred compensation items becomes an ineligible deferred compensation item. Big difference. So watch out the timing of WHCE. Number two, if you happen to own any rights, distribution rights from non-grantor trust, I am not talking about that particular side of the taxation, but if you have some interest, if you think you want to receive some money from the trust in the U.S., there will be a taxation if you are covered expatriates. Remember that. Okay. So I run it very quickly, but this is our disclaimer of our video, and this is our ending page. I hope you enjoyed our video. Thank you. Have a great day.